Welcome back. You're watching Keeping It Real, and I'm here with Sharon Schimover, mortgage specialist extraordinaire. Sharon, welcome to the show. How are you today?
I'm good, thank you very much.
Thanks for coming down on the weekend. I appreciate it.
Thank you.
I know you're used to working weekends. Now back as a mortgage specialist again. You have been working with a couple of different institutions
Yes.
for a little while. You were a mortgage specialist before.
Yeah.
You had joined Exceed. We can say
Yeah.
you've been with some terrific institutions over the last few years.
I was a mortgage agent, and then I joined Exceed, and I was with GE Money, and most recently with Home Trust.
Right.
So really great institutions for non-prime lending.
Great institutions and great experience as well. Knowing what's happening, from a lending point of view is very valuable experience now. Being an agent again, so that's very valuable. Now you've been in financial services for over 20 years.
About 22 years in the financial service industry, with a focus on mortgages for a little over 15 now.
So lots of years in mortgage lending, and you haven't gotten tired of it yet.
Not yet.
Not yet.
Changes
Okay.
too often.
Right. Well, listen, I remember that you were very kind when you were with Exceed, and I had just started as a mortgage agent at the time. You came out, you talked to me, and you gave me the benefit of your insights, and then also when you were at Home Trust, you were supporting me as well. Sent you a couple of deals, not enough, but we try. And now you're a mortgage. How come you decided to get back into as a mortgage agent?
For many reasons. I loved it the first time around, and working for the lenders, I loved working with the broker division, but it made me miss it that much more, realizing that I wanted to work directly with the client.
Right. So how long have you been back into this now?
I've been back into it for about 2 years now.
2 years? Oh, quite a while. So it's been a while since you and I connected. It didn't seem like that long ago.
Yeah, it's been a while.
You're at Home Trust. So glad we connected on LinkedIn.
Yes.
Great place to find some of your old friends and contacts. So tell us, what do you see happening in the market these days? You're specializing now still mainly in A lending?
A lending as well as the non-prime lending. We do all facets of lending, but the average client that comes in either will fall into an A client, which will be your Scotia of the world, TD, and so on. Or if they don't qualify, they then move on to non-traditional private sourcing. So.
Okay. How do you determine where to take a client? You probably have dozens of different lenders that you can choose from for any particular application. How do you determine?
We can work with about over 25 lenders. That's the accessibility that we do have as mortgage agents. For a client, when they come to us, there's a lot of things that we take a look at to determine as to whether they would or would not qualify with the lender. So it's beacon score driven, income driven, how they have paid their credit, how much credit they do have, how long they've been at their job, and whether it's what style of job. Is it business for self, is it stated income, or is it a full-time earning income? So there's a lot of things that come into play as to how it is that we would look at it to present it to the lender and what it would qualify for under what program.
Okay, Sharon, tell us what's the story now with mortgage rates? We're still under 3% on some rates. I mean, they've been so low for so long. Is this a big factor, do you think, in what's keeping the market buoyant, at least? I mean, what do you see happening nowadays in the market?
The rates are at a historical low. We still have some rates that are hovering in and around the 265, 275 rate for a 3-year. They have been slowly moving up, but nothing overwhelming. You're seeing rates going up from 299 to 309, for example.
For like a 5-year term.
For a 5-year term. So we're still at a very low rate. So for a client who's getting into the market, where we were 4 or 5 years ago at 5% for a 5-year, this allows a client with a minimal down payment to be able to maintain decent payments. So the rate does make a huge difference for a client. So it's helping clients not only to do, you can refinance high debt and put into a really low rate, minimize your monthly flow of cash, and really buy a property that you may not have been able to afford.
What are most people taking nowadays? Are they going for the 5-year fixed rate, or are they looking to the 3-year fixed rate? Are variable rates history?
I don't think variable rates are history. They're not as low as they used to be. However, I find that with my clientele, we're really at the 5-year mark. People are looking for stability.
So people still like that 5-year fixed rate.
Yes.
And what about things like self-employed mortgages? There was a time when you could get a self-employed mortgage, no proof of income, with 5% down. Those
Yeah.
days are gone?
Yeah, if you had a pulse, we got you a
If
mortgage.
you had
No,
a pulse,
I'm
you
just
could get a
joking.
mortgage. Pretty close.
But it really has changed
Right.
now. You have to have a minimum of 10% down on a purchase, and there are minimum beacon
As
scores.
without proof of income.
And that's where things have changed. It's not that we don't have to prove income. We have to prove the reasonability of a client's
Okay.
income, of the reasonability of the business, and how
Okay.
viable that income could be. So we have to prove that to the lenders and in turn to the insurers. So there's more hoops to jump through. So it's not just you're buying $1 million house, you need XYZ in terms of a mortgage, and therefore we need to show that you make this much money. We actually have to show that it's reasonable that you make that much money to qualify for the home.
So you may not have to be able to show actual proof that you're making, let's say, $300,000, which might be a number that you would normally need to qualify for $1 million mortgage, let's say. But you have to be in a profession that it is you can say that it's
feasible,
reasonable.
and so there's certain ways to do that. So if your NOA shows $5,000 and we need to show that you make $300,000,
that's a stretch.
a bit of a stretch, going to be a little difficult. So there really is add backs that we can use, certain things that we can show where there is a reasonability factor that in a year, that is what a client makes based on that profession, based on that industry, and based over the last few years of their filings. So it doesn't mean that you have to show the exact number, but it does mean that we have to show something close to it and a plausible story to it. So things have changed in that regard. It's 10% down on a purchase. On a refinance, for most lenders, it's 65% now, and it used to be much higher.
65%
Correct.
only on a refinance?
It's 65%.
That's very low.
It is very low, and it's because it's on a stated income. Now, in some situations, you can get higher.
Okay, so we're talking self-employed.
Yes, on
Still,
self-employed.
okay, gotcha.
So in some situations, there is a possibility to go higher, but on an average, we're looking at 65% on a refinance for self-employed clients. So it's
Okay.
really changed for them.
Okay, now people who have regular jobs with salary and they can prove income with pay stub and everything like that, still 5% down?
5% down on a purchase. Refinance has dropped to 85%.
Okay, so that went from probably 90 or 95 a few years
was
ago,
95,
and gradually
went to 90,
they've
now
cut that
85.
back.
Yes. So
and
that has changed, and the amortization has changed.
Amortization is
on
now what's the maximum
High
amortization?
ratio, it is 25 years, and high ratio is anybody who's putting down less than 20% as a down payment.
Okay,
So then it gets insured. So if it's insured, you're looking at a 25-year amortization. If it is not insured and you're putting over 20% down, you're still in a position that with many lenders, we can do a 30-year amortization. And with select lenders, not everybody has pulled out of the market, a 35-year amortization. But for the most part, you're looking at a regular standard mortgage on either a refinance or a purchase that is going to be insured. You're looking at 25-year amortization, and that's dramatically changed.
so now real estate prices are still reasonably strong in Toronto and Greater Toronto area. But number of transactions seems to be low. Real estate agents are talking about lower number of transactions. Do you think that all this tightening? I mean, there was a time when you could get a mortgage with 0 down on a 40-year amortization. I mean, that's a big difference than a 25-year amortization and 5% down. That'll block a lot of first-timers out of the market. Do you think that has a lot to do with the action in the market?
I think that this correction in the market and what is happening, it absolutely is tied into it. Because if you think about what a year ago or 2 years ago even, a new purchaser was 0 down or even 5% down qualified for on a 40-year amortization on that same income level. Today, going on a 25-year amortization, although the rates are really low, they're not that low that it makes up for a 15-year amortization difference. So if it really is a position where you really, on 25-year amortization on your income level, you qualify for this mortgage. Whereas on a 40-year and 100% financing, it was really such an extension on a payment for a client. And so a lot of people were able to qualify had they not qualified. Whereas today, people who qualified 2 years ago wouldn't necessarily qualify today.
What do you see happening with rates this year? Are we in for increases? Do you think things are going to stay where they're at right now for a while?
From all the feedback that we're getting, rates have been very, very low for quite a while now. They've continued to maintain themselves, and we've heard that they will continue for the next year to stay really low until they start to slowly go up. So I think we're in a really good position for clients who do want to do a refinance and take on all that extra debt and get a better cash flow for their household. And I think for clients who are looking to purchase, whether they're first-time home buyers or second-time home buyers, now's a good time to be able to lock in a 5-year rate.
Okay, very good. So good time to refinance and still a good time to purchase with rates as low as they are. Sharon Shilmover is with the Mortgage Center, iDirect Mortgages website, mortgagecenter.com/Sharon Shilmover. And we put her phone number on the screen. It's 647-389-9038. Sharon, did we miss anything about mortgages? You're forecasting rates. What about tightening? Do you think there's going to be any further tightening of lending rules, or do you think things might just stay where they are? Do you have any idea?
I think that in terms of the lending guidelines, they are going to continually change. We can't avoid that. In terms of them tightening, I think we are going to see a bit more restriction on them. I think as we are going into a time period where we are lowering the amortization period, we're not, the access to money I don't think is as readily available as it used to be.
Right.
And so I think that there will be a bit more of a tightening on the reins a little bit. As to how far it'll go, we don't know until the rules come into play, but I think that there will be a little bit more tightening over the next year to 2 years.
Okay, well, very good. So you want to get moving now before things tighten even further. Sharon Shilmover, 647-389-9038. Sharon, thank you very much for being here. Very much appreciate it. You heard it here on All Talk TV. We're going to take a short break, and when we come back, we're going to talk with Joe White, the franchise rainmaker, finding the right business for you. Hang on, we'll be right back.